Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Prerana, fixed income strategist. With an objective to empower you with investment insights, on this program, we discuss various perspectives that are shaping the global investment landscape. Last week, the focus was on the central bank policy meetings. As anticipated, the Fed raised policy rates by 25 basis points, keeping the terminal rate unchanged at 5.1%, with one more rate hike of 25 basis points penciled in for May. The key notable changes in the Fed policy statement were the upward revision in the Fed fund rate projections for 2024 to 4.3% from 4.1% previously in the December meeting, and the downward revisions in real GDP forecasts for 2023 and 2024. Fed Chair Jay Powell acknowledged the banking sector crisis, stating that tighter credit conditions could weigh on the economic outlook, but mentioned that the Fed had no plans to cut rates this year. Amidst the flare-up in banking stress and dovish central bank expectations, developed market bond yields have declined over the past 3 weeks, led by the US Treasuries. The 2-year US Treasury yield has dropped to the lowest level in 6 months, as rate markets price an end to the Fed tightening cycle, with rate cuts of almost 100 basis points being priced in the second half of the year. This is despite the Fed assuring that no rate cuts are being planned for this year. With the shortened US Treasuries leading the decline in yields, the US Treasury yield curve has bull steepened over the past few weeks. In fact, the 30 to 5-year US Treasury yield curve has moved back into the positive territory. Such steepening moves typically coincide when the Fed hits the pause button. While we agree we are now in the last leg of the central bank tightening cycle, we do think that some of the rate cut expectation that markets have priced in recently look overdone. We believe that the bond markets have moved way ahead, and the recent bond market performance, particularly at the short end, looks stretched, given the wide divergence between the market rate expectations and the Fed projections. Moreover, growth concerns may have amplified during the ongoing banking turmoil, but do not match with the current economic reality. Recession probabilities over the next 12 months have remained stable and not moved higher despite the slowdown concerns. In addition, soft and frequent indicators, including the recent PMI surveys, only point to economic resilience. As such, we believe that the banking sector crisis will remain contained, and more importantly, growth expectations are unlikely to materially deteriorate in the near term. We expect bond markets to underperform and expect recent bull steepening trend to reverse. As a result, we recommend going underweight on bonds and overweight on equities, with the scope for improvement in risk appetite to benefit the latter. We maintain our preference for 7 to 10-year US Treasuries. Historical precedents, in fact, have shown that intermediate term bonds tend to outperform after the last Fed rate hike in the tightening cycle. As always, thanks for listening to our podcast. Hope you find it useful. If you do, please share it with your family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log into our website at www.adcbam.com. This is Prerana signing off.